David, thanks for coming back on the podcast with us.
My pleasure, James. It's good to be back with you.
Well, David, we did a little pre-interview discussion. We were talking through Twitter a little bit, some of the various subjects that we wanted to touch upon. And we just discussed it. I suppose we should start off with probably what most investors are most interested in out there, which is silver. Obviously, the price has gone down over the past few months from 17 down to low 14. We have seen a recent boost, I suppose, in the price. Today it looks like it's up pretty good amount in the mid 1450s. But before the interview, we discussed a little bit about lease rates for silver. If you don't mind, to begin, just to kind of cover what lease rates are and what they mean and what's going on with silver lease rates at the moment.
Yeah, so the silver lease rate reflects the cost to borrow the metal. The lease rate that I'm following is the rate in London, which is the world's primary precious metals market, at least for the West. And so been following the lease rate, the cost of borrowing silver, and we've seen the price plummeting here basically since June. It was in the mid 17s and fell down to about $14 recently, and the lease rate during the same period had gone from a negative rate, so it's a negative cost because storing and insuring silver is expensive. It's very bulky. It's a relatively low value in terms of the volume consumed. If you compare it to gold or palladium or platinum, it's much more expensive in terms of just the space it takes up. And so it was interesting while this price action was falling, and as you and I have discussed, I'm very skeptical of the price setting mechanism in London because it uses unallocated contracts which aren't backed by metal. It's just digital or virtual metal trading. And so while the price was falling, that the actual lease rate, even on the short term, which is a 3 month a term that I'm following for the shorter term lease rate, had gone to a positive value. So when we look at the cost of storing in terms of space it takes up, there's an insurance cost. And in terms of leasing, if you want to take possession of the physical metal, you've now got to move this large volume of silver. So very different very different signals being sent from the market in terms of the falling price in the London paper market and then the rising lease rate to a positive value. It's not a very high value, but it's a positive value nonetheless, showing that there is demand for short-term 3 month silver in London at the same time. So we'll have to see how this all shakes out, but there's the two signals are working against each other. And I suspect that the paper price that we're following is not giving a virtuous true market signal in terms of price discovery for the actual demand for the metal itself.
I see that JP Morgan's COMEX warehouse is just dipped below 140 million ounces. I believe it was up near the 145 million ounce threshold just a month or two ago. So that's 5 million ounces walking out the door, and probably because of what you're talking about, where tightness in physical, or there is just demand for physical in the short term, and perhaps that's why some of the silver is going out the COMEX warehouse at JP Morgan.
Yeah, it's because of the market structure that we have in terms of paper trading versus true trading of the metal, price discovery of the metal. It's very, very difficult to tell exactly what's going on at any one time. So lots written about JP Morgan silver holdings, but I don't know if anybody knows who actually owns that metal, if it's JP Morgan as the trading house or whether it's a client that they're holding it for. So there's quite a bit of uncertainty there.
Totally, totally. Well, moving on, obviously we'll probably get some more insight into that as the months come along. But moving on, I wanted to talk about, of all the four main precious metals, you're talking about gold, silver, platinum, and palladium. When you look at the charts, especially the long-term charts, and the one that looks the most bullish, pretty obvious when you look at the various four precious metals and their price action, is palladium at the moment. Palladium I think, hit a record high in January, and it's since bounced a little bit downward, but it's rebounding again. And you've done a lot of work. I've read on, uh, I think, Seeking Alpha. You've done a lot of articles that you wrote years back talking about the issues with palladium as far as the physical market versus what's going on with price action. So if you could give us some insights, I know the lease rates in the palladium market are pretty high as well. So that'd probably help us to understand what is going on with palladium.
Yeah, so the lease rate is the rate I'm focused in on because I'm looking for the supply demand market indicators of what's going on in the market. I don't trust the price signals that we're getting, and the palladium lease rate, it spiked to an intraday high of 21% in June of 2017. It just took off. It came back somewhat, but it's held, above 5%, and now it's rising back up again above 7.5% in terms of the per annum cost of leasing, both the in the short term and the longer term. So there is a real physical metal shortage, and the CEO of JENSEN, Matthew, a couple of years ago, did an interview, and he said that the major palladium stockpiles had been moved from Switzerland to London from 2009 to 2013. So over that period of 4 years, the major stockpiles had been already been transferred. And I looked into the UK customs data, and they indicated a between 2016 and 2013. So after that, or just overlapping that transfer period, that there had been a net transfer out of the UK of about 5.5 million ounces of palladium. To put this into context, the annual mine supply is about 6.5 million ounces. So that's quite a bit of metal in this, it's very much a boutique metal, a small market. And one other element here is that 40% of it comes from Russia and 40% of it comes from South Africa in terms of the annual mine supply.
Right.
So, we're seeing here in this market, elevated lease rates in London for more than 18 months. And now in the near term, the lease rate has been rising again. And, we're seeing the price starting to respond. It did decline from the beginning of this year till recently, but all of a sudden, over about the last 2 weeks, the price has taken off again. So I think that we're seeing, the paper market is starting to respond to the actual physical shortage of this in the market. It becomes very, very difficult to contain price when you have physical metal shortage. You can set the price anywhere as long as you've got metal flow that equals the demand. The game that I see, James, in London is that they have very little inventory backing up the claims in the market in the spot market. And it's the spot market that sets the price because, that's the ownership of metal, immediate ownership, right here, right now ownership. And you can deflect various funds or users of metal into holding these unallocated, unbacked spot contracts. But when there's urgency for actual metal delivery, which, the vast majority of palladium is used in catalytic converters and automobiles. So when there's a shortage and a demand for the actual physical metal, there's very little you can do in terms of deflecting interest into holding unbacked spot contracts. Mm-hmm. So that's what I see happening right now as I see a breakout of the price. It was in a downwards flagging pattern since roughly January, and about 2 weeks ago it turned around and it started to take off. And it's going to be very interesting to see how this dynamic plays out because without this metal in the catalytic converters, you can't ship automobiles, and it's very expensive to shut down an entire auto plant because you can't get a $500 unit to plug onto the exhaust.
Right. Yeah, just 2 points about this. Looking at the price chart, it does look like it's a head and shoulders. So I wouldn't be surprised to see, with everything you just described, the price to continue higher and probably go past or at least meet the record high from January. And then the other point about the physical world meeting the reality of the situation physically versus the derivatives that kind of shield the real supply demand fundamentals. Back in 2000, I think there was a shortage of Russian palladium, correct? And that's what kind of caused this mania in palladium prices, where it looks like in early 2001, palladium got over $1,000 an ounce, which was 4 times the price of gold. And the
Yeah.
reason why was essentially that Russia was not exporting palladium, and just this mania and price ensued, and palladium went up in a five bagger within a couple of years' time. So
Yeah.
this
There was a
is
real panic at that time in London. I think they almost lost control of the paper market at that time.
mhm.
And Russia had roughly, it's estimated, about 25 million ounces in stockpiles of palladium. And they stepped into the market at that point and basically saved London's paper market by just stepwise offloading a portion of this of their stockpiles into the market to meet the deficit. But there was Dresdner Bank almost blew up. The banks were calling for the U.S. to release palladium from their strategic metal stockpile.
Mhm.
They were so desperate, and the lease rate at that point, which is interesting, but the 90-day lease rate went to a per annum rate of over 300%. That gives you an idea of how desperate they were for metal at that time.
Jeez, 300% lease rate.
Yeah,
That's nuts. Um,
hold that for too long.
yeah, just looking at, like, for instance, the palladium ETF. There's a chart in Bloomberg showing how much physical has been drawn out of that palladium ETF in the past 2 years, 3 years,
Yeah,
versus how much is still in there, and it goes to show that the physical demand is obviously at really high levels right now, and probably continuing. If we have any issues with Russia or South Africa moving forward, Lord knows what could happen.
yeah. I think it's roughly 70% of the metal in the ETFs have been pulled out.
Wow.
And so if you're getting to the point where you're drawing from the ETFs to meet physical delivery requirements, then you know that you've got a serious deficit in the market. And palladium, platinum is a substitute, but there's a cost of switching over to platinum. And the platinum stockpiles are not that great themselves. I mean, there's more platinum in stockpiles, in the UK and in Switzerland, certainly than there is of palladium, but they aren't robust in terms of, if you compare them to gold, for instance, in terms of the above ground stock. So,
Correct. So, switching gears, moving on to the petro oil situation. Last time we discussed this, I think it was in May. I put a chart in the article and the video, I believe, kind of just showing the share of overall in crude oil trading, how much share that China had at that time. It was in May, and now I'm looking at that chart again. This one that I'm looking at is just a week or two old. And it looks like you roughly double the amount of volume, that the Chinese petro yuan oil trading contract has in the overall global oil market, which is not a small thing. I mean, the amount of
yeah.
share that's growing it seems to be pretty large month on month. And if you just continue on this trend line, it looks like they're gaining more market share as time goes along. I see that you've tweeted a lot about it lately. I wanted to hear what your latest thoughts are.
Yeah, sure. I mean, the futures contract that is being traded in Shanghai, they're offering gold settlement for physical oil delivery, which relights the petro-gold trade. And I say relight, it's because that trade existed prior to 1974. Henry Kissinger negotiated a deal with the Saudis and ultimately with OPEC that they would only price oil in U.S. dollars, and that helped create a global demand for U.S. dollars. So what China has done is reintroduced physical bar settlement for oil delivery at the option of the oil deliverer. Now, the futures contract is one element, but we know that Iran and Russia have both been delivering oil to China over this period, and China is the world's biggest importer of oil. The last I checked, there were about 9 million barrels a day of imported oil. And the reason this bar settlement, James, is significant is that in introducing it into the oil market is that the dollar value of oil produced every day is 20 times the dollar value of gold produced every day. And it's the annual production of gold from mines, which is the readily available source of gold. Unfortunately, the major gold miners basically just dump their metal into the market. They don't use any of the approach that Rob McEwen introduced when he was CEO of Goldcorp. He would hold back gold when the price dropped and then reintroduce it into the market when the price went up. And as I alluded to earlier, the game that's played in London is that they park demand for metal in paper, and they've got to have the flows to maintain the appearances of a real market to hide the fact that there's fractional amounts of metal backing the hundreds of millions of ounces of gold spot contracts which they've written. Mm-hmm. So the petrogold trade, now to circle back to that point, is that it's price insensitive demand for bars, and you're really using an enormous lever in terms of oil, which is 20 times bigger than the gold market in terms of daily or annual production. And it's bar demand that they're creating with this settlement tool. So some of it will go through the Shanghai Energy Exchange in terms of the futures contract, but the off exchange delivery of oil, such as from Russia and from Iran, is going to get the bar demand. It won't be visible through that mechanism, but it's going to get the bar demand in terms of the portion of the oil that they choose to settle in gold. So we have to see how that plays out. But what's really interesting for me was to hear the announcement that Europe, Russia, China, and Iran had agreed on developing a new settlement mechanism to deal in trade with Iran. That came out 2 days ago now, that announcement, and CNBC said it would never work, and Bloomberg made kind of an offhanded reporting of it, but no one's really focused on what this means. Is that you now have a non-SWIFT settlement system being developed with this bloc, and it's not an insignificant bloc by any means, Europe, Russia, and China especially. But they are going to allow settlement for trade of oil with Iran to go ahead. And this is one more, let's say, destabilizing step taken towards a decoupling of U.S. dollar settlement for oil and ultimately of the demand for U.S. dollars as a global medium of exchange.
Right. I mean, if the major currency that's used to trade oil has been the dollar for decade upon decade, ever since Henry Kissinger kind of made it that way in the mid 70s. These are the steps down that lever, I suppose, slowly but surely. When things like this are happening, it's just kind of another sign on the way to a more multipolar world, I presume.
Yeah, and if people say, well, they'll just use euros, as an alternate, fiat money settlement mechanism. I mean, the euro is not strong by any means. If you look at things like the Italian debt situation, the Italian debt is the equivalent of subprime mortgages in 2007. It just hasn't broken down yet, but everybody knows that they have a unsustainable situation there. Mm-hmm. And the knock on is not just going to be Italy as a isolated problem in the Eurozone. They all have this problem of which, governments have. They like to spend more money than they take in, spread largesse, which is non-existent around while they can do it. And so I think that what we're going to see here is really ultimately a movement that is going to be militated towards a gold bar settlement for physical oil delivery. I think that's where we end up. The question is, how fast do we do it? But Europe is heading into a serious situation right now, I just don't see it as being a long-term solution. This new settlement mechanism being based on euros itself.
I mean, at the moment, commodities are about as cheap as they've ever been versus stocks or other paper assets. So the
Yeah.
reversion, if that is the case, if that's what's coming ahead, could make the commodity bull market 2000 to 2009 look like the first step. But obviously, this one could be even larger.
Yeah, and a lot, not well, a lot of analysts totally ignore the importance of energy to social stability. We look at the energy in a barrel of oil. The equivalent energy in a barrel is the labor that a man can do physically for 10 years, 8 hours a day. And that's an enormous amount of energy stored in a barrel of oil. And if you think about, well, we'll just revert to something else, the question is, well, what?
Mm-hmm.
What are we going to use? And the fact, over the last 20 years with the advent of the internet, along with that rapid information transfer, has come the just-in-time delivery system. And there are no large inventories of almost anything in society anymore. The grocery stores and industry, I mean, the trucks have to move every day. And so we need diesel every day to be freely available with no disruption, or you start having disruptions to supply chains. And the problem is that once you have chain disruption, you start to change consumer behavior, and you have things like hoarding that happen where individuals forward buy and stockpile because of uncertainty of availability. You have a serious problem in society because of the very small stockpiles that are available in the system for increased consumer demand or demand of any consumer or user of materials in industry or in society in general. So there's very, very little room for any disruption or perceived disruption to the availability of oil. And my concern is here that if there's any kind of a question in terms of the validity of the settlement mechanism for oil, that some oil users, or sorry, producers at the margins may decide to hold back physical oil delivery or reduce physical oil delivery until that uncertainty is removed. It takes very little drawdown in availability of energy to start having a really material impact on society as a whole. And once, pardon me, once the lash effect occurs in the supply chain, it reverberates throughout the supply chain back and forth, and it takes a long time to get back to an equilibrium type of even flow. So I think the whole settlement mechanism for oil and the ultimate question of what is our unit of exchange going to be is extremely important in the society that we live, that has so little tolerance for any kind of a disruption.
Once that goes, obviously, the dominoes where it can go from there, they can kind of get away from people. So I certainly understand the concern.
Yeah, so I see the knock on, like, from one exchange medium, if there's any question about it, that the transference through to ultimately to a gold settlement, it'll take some time, but I think it's the end station, and I think the consequences of uncertainty are so large that it's going to be much faster than most people perceive. It's not a 5-year process.
Yeah, so you're saying it's, step by step by step, we're leading towards something, but when it finally becomes apparent to the market, it will be very apparent and very quick.
Yes.
Well, David, thank you for coming on. Is there anything else that we wanted to mention to the listeners before dropping off? Maybe how they could follow your work, where they can find you?
Yeah, I post my daily thoughts on Twitter now. I post under the handle Real David Jensen.
Mm-hmm.
So that's just real David and Jensen, JENSEN, with no spaces, and they should find my work. And that's probably the best spot to leave it. I'm just following things as they progress here, but I think that we're getting to a point now where our change is going to be very, very kinetic. That I see this. There's been a long build up to the point that we're at now, but the pieces, the major pieces, are in play now, and I expect we're going to see change quite rapidly in the time